CEO of banktothefuture.com. Simon Dixon joins us from London. We have journalist and broadcaster Max Keiser, who's joining us from Paris, and Secretary General of the SIPI Foundation, Paolo Raffona, who's joining us from Brussels. Gentlemen, welcome. I'd like to first start with you, Simon Dixon. Interesting, before getting into the debt issue of different countries, what is going on with the oil prices? Right now, crude has plummeted from $106 per barrel in May to $99 per barrel, hovering around that price. The reason that's been given a global slowdown led by Europe, the United States, and China. Explain that to us. First of all, why those countries are leading to this global slowdown. What is exactly global slowdown? Is that what's happening?
Well, we're seeing one disaster after another. We have to remember that the major issue that we're experiencing right now is a banking crisis, and a banking crisis leading to governments going through austerity measures. And those are the major issues right now. Now, that has all sorts of effects and all sorts of knock-on effects with all the global markets. And the latest one to participate in that is what we're seeing with the oil markets right now. But just another measure and side effect that we see from a broken banking system that's leading to worse and worse situations.
Like what's going on in Spain. Max Keiser, looking here, 4 or 5 years of austerity measures have failed to stimulate the European economies on a whole. How can economies be stimulated and then create jobs at the same time if there's a global slowdown occurring? If you agree with the fact that there's a global slowdown.
Well, let's look at the case of Ireland for a second. A few years ago, the Irish public debt was virtually non-existent. Then one of their banks, Anglo-Irish, ran up debts that were 10 times the country's GDP. They went bankrupt, and the Irish government decided to move those debts or guarantee those debts onto the balance sheet of the citizen. And then they started imposing austerity measures to bail out Anglo-Irish Bank and their unsecured debtors. So this pattern is what we've seen play out all over Europe. You've got these debts that were incurred by banks. They can't pay the debts, and the governments are doing the bidding of the banks by transferring these debts to the public and then imposing austerity measures. We saw it in Argentina. Citibank was in Argentina back in the late 80s, early 90s, or late 90s to 2000. And they went bust, basically, and the government forced the citizens to pay off Citibank's debt. So that was the model. So this is a common theme. Now, until you do something about these transference of bank debt to the public, you're going to have these problems continue. It's playing out all over the world.
And something that's continuing over and over again, Paolo Raffona, are these austerity policies that's promoted by the European Union, the ECB, and the IMF, and it's been called economically inefficient. Explain that to us.
Well, the policies that have been put into place from the European institutions, the so-called Troika, are still policies based on the concept that austerity will cure the crisis. We can see someone who is deviating from this, and this is France, that has not denounced the agreements of last June at European level, but on the same time, President Hollande is instead spending more public money to create jobs. He has announced to recruit a great number of people in the public administration. He is intelligently selecting the spending of public money in France for more productive type of investments. So there are solutions which are different from the pure austerity. The austerity itself should be a temporary measure, and instead it seems the only solution that the European institutions are proposing to the governments.
June 27th, Simon Dixon, there was a nightmare scenario that was predicted when it came to Spain for Europe's leaders to ponder about, and that was if a bond auction was to fail in Spain, the spreading of solvency and its worries were to go and spread to Italy and beyond, and it would trigger uncontrollable bank runs that would spell the single currencies end? Are we looking at that situation? Because Spain has not even shored up enough interest locally for this bailout. Well, I'm sorry, they call it a restructuring that they've asked for to the tune of close to 100 billion euros.
Well, you have to remember that all we're seeing right now is no change of policy. We're just seeing new innovation, new products, new ways of banks essentially finding new markets for their debt, or central banks finding new markets for their debt, or European banks finding new markets for their debt, because all we're doing is perpetuating a system where we have to increase our debt in order to survive at the moment. Because as Max said earlier, we're just transferring banks finding markets for their debt and then secured by the government, and then the government trying to find a new way of bailing out the banking system. And all we're doing is we're just playing this domino effect, and then we're coming up with new innovation where the countries that are in trouble are bailing each other out, and soon we'll be asking Ireland and all sorts of other countries to bail our systems out, because we're all in this together, just perpetuating a system, and we need to look at the root cause of the problem, and we're not doing any of that.
Well, the root cause of the problem, Max Keiser, is something that it seems that it's not being tackled, because it seems like just by buying time and getting these loans, of course, some are wondering where the money is actually coming from. Maybe it's the citizens of each country. Like in the case of Greece, you have 20 banks that have lent Greece money. Ultimately, are they going to be able to pay back? In Greece's case, for example, are they going to be able to pay back the money? I mean, that's the fundamental question that is facing some of these debt-ridden countries, isn't it?
Well, to follow up on what was just said about finding new markets for debt, to fine-tune that a little bit, they're finding new ways and innovative ways for the banks to sell debt back and forth to each other without having to increase their reserve requirement in any way. In fact, reduce their reserve requirement. So you have a bank like Deutsche Bank with $3 trillion in debts that is supported by less than 1.5% of Tier 1 capital. So you have less than a 1 or 2% fluctuation in the value of those assets, and the bank is technically bankrupt. These banks in Europe are technically bankrupt. Their balance sheets, if you were to freeze frame them and forensically look at them, you would find that they are without any collateral whatsoever. They're only supported by the illusion of whipping these debts around in the washing machine that is the euro money laundering system to keep themselves going. And like, for example, they introduced the European Stability Mechanism. This just means that the same debts that were swapped amongst banks 6 months ago are being swapped again into a new lending facility that's collateralized by the same banks. This is the very definition of a Ponzi scheme. This is what put Bernie Madoff in jail. And this can continue on additionally, because what will happen is that once they establish a European-wide central bank in Brussels to mimic what's happening in Washington, D.C. with the Federal Reserve Bank, and then once that game runs out, then the Federal Reserve Bank and this new European Central Bank in Brussels will create a new global central bank. And they'll do the whole thing over again. And then everyone who's suffering austerity today will have to pay additional tax to this new global central bank. So the people suffering austerity are going to continue to suffer austerity, except their tax burden is going to continue to go up substantially. And the bankers who make money creating this Ponzi scheme will continue to suck wealth out of the system and lord it over in this neo-feudal model, as they've been doing now for the past 5, 10, 20 years.
I believe we have to replay that a number of times, at least for me, Max Keiser, to understand completely and get a handle of what you just said. I'm trying to figure out with this global banking system how countries are going to react to it. I believe it was the case of Norway, Paolo Raffone, where this global banking system, in essence, asking countries to share debts and pay off other countries' debts. Isn't there a problem with that? We already had, I believe Norway was rebutting this and saying, we're not going to pay off debts, and they asked for some kind of collateral. But tell us what's wrong with this global banking system when it comes to paying off debts of other countries.
Well, I think what Keiser explained is that the issue of moving the debt from one place to another just to hide it in a way, because I use now improper financial words to make it maybe easier. But this is the point that is happening. The debt has been created out of a system which has faults within. Now we are tackling the effect of that system, which is the debt, and we are trying to solve the problem having someone to guarantee for that debt. But the debt is still there and even increases to a certain extent. The austerity measures are meant to intervene to try to reduce the debt, but in fact they are increasing it, because once the austerity measures are into place, the economy holds, and therefore there are less taxes paid to the states, and therefore the public debt increases. And similarly for the banks, if they have loans or mortgages and so on, people are unable to pay, and so their debt is increasing and not diminishing. So the entire system is managed in a very unclear way. I seriously do not see how do they think to get out of this problem they entered. On the other hand, we have to see that in the United States some steps forward have been made, because there is a central bank which is a real central bank, there is a government for the entire Union of United States which is a real government, and therefore they can take measures to tackle certain speculative activities of the bankers. In Europe we have done nothing. 3 years have passed, no legislation has been adopted, and therefore now there will be a regulatory mess between the US and the EU on the issue of derivatives and other kind of structured financial instruments. I do not see really how do they think in Europe to come out of this mess with this kind of construction which is full of funds that contradict each other, and nobody really knows which one is funded enough to fund the debt of that country or that bank or the other bank. So it's really very, very confused.
Exactly. Simon Dixon, let's take 4 of those countries that are in the Eurozone that are surpassing 100% of their GDP. Ireland at 108%, Portugal also at 108%, Italy at 120%, and Greece at 180%. What are these countries going to do to reduce their debt other than austerity? I mean, are there countries in the Eurozone, I'm sure there's some that perhaps are doing okay when it comes to their debt to GDP ratio that maybe you could use as examples for us?
Well, the debt is never going to be paid off. It can't be paid off. And we have to stop pretending that the government actually wants to pay it off as well. Because we have to remember that when you've got a system where all money is essentially debt, which is the system we operate in today, if they ever repay that debt, we end up in a scenario where we don't have enough money for our economy. So the only way that they can actually look at that is actually restructuring exactly the essence of money, and the fact that money is debt is a huge problem. And as Max Keiser touched upon earlier, there's only one result that this can all lead to, and that is that every country loses their sovereignty. Is that there's consolidation of power to an IMF or a European Central Bank or whatever the next one is, because all of these countries are operating off a system where they won't let the banks go bust. Therefore, the government have to take on the debt. They can't repay that debt, so it gets restructured into a central bank, and that only leads to an IMF with a special drawing right and all sorts of currencies that we've got coming up. And it's all consolidation of power, and we're just moving in that direction, and that can't be reversed without actually looking at the true nature of our banking system, money creation, and things that no one looks at today. They're not asking the right questions. They're just looking at austerity in order to reduce the government debt, but that's never going to work.
Max Keiser, but in between the lines here, it would be positive to see what actually are on the books of these different banks. Are there hidden costs? Because it seems like, for example, with Bankia, when we hear about the bailout that they needed, do these countries know how much their banks have on paper in terms of assets, in terms of funds, before they can reach out and bail them out? Or are these debts going to all of a sudden surface in the news that they owe this much more? If you can elaborate on that more for us or give us examples?
Well, no, they don't know how much debt these banks have. It's part of what's called the shadow banking system. The shadow banking system in America is estimated to be over $16 trillion. So it's in excess of the entire GDP of the United States. And this is true throughout the world. There's $800 trillion in derivatives that are part of the shadow banking system. The entire globe GDP is, call it $50 trillion. What happens is that when banks want to get more laws passed to deregulate the system, to make it easier for them to continue this Ponzi scheme, they suddenly flash huge debt that they said they just found, they just discovered it. Hank Paulson did this in 2008. Dick Fuld did this at Lehman Brothers. The Troika did this when they were talking about Greece. They have trillions of dollars worth of debt that they can use as a scare tactic to get the citizens and the government to sign off, as was the memo of understanding with Greece, with the Troika. And then when they sign it off, they suddenly say, okay, well, this new lending facility is going to take care of this debt. We're going to lower interest rates again towards 0%. Of course, so the debt service is down to as low as it possibly can be. But I want to follow up on a point of Simon Dixon about the nature of money itself. Most people assume that a bank takes in a deposit and then they loan that deposit out, and this creates liquidity in the system. That's false. In today's banking system, banks first lend money into existence. That's where money comes from. It's loaned into existence as debt. A small fraction of that ends up on another bank's balance sheet that they then call collateral. But it's just debt. There is no hard collateral. That's why at this time around the world, there's a mad scramble to try to reclassify gold as a tier 1 asset, because that's the only unimpingible collateral that you can have at this point to solve the fact that none of these banks have any collateral that's worth anything in a resale market. They are all technically bankrupt. And this is what they discovered in Iceland, which is why they had to let the 3 banks, the major banks, collapse. The currency collapsed, the economy collapsed. But now they're growing again because they went through that moment. They realized that they had this huge problem. These banks in Europe have to understand that they must allow the banks to crash and let happen what's going to happen. But until that happens, there's going to be more debt servitude, more problems like we're seeing, more austerity, and more social unrest. There's a real risk now that some of these bankers are going to be rounded up. In the mainstream media in America, Nobel Prize-winning economists and people like Nouriel Roubini are suggesting that bankers should be hung. You know, I said that on this show 3 years ago, and people thought I was being, exaggerating. But now Nouriel Roubini is calling for bankers to be hung. So this is a very interesting sea change.
So, Paul Rafona, where does that take us to? What are we looking at when it comes to the Eurozone? Spain, we're looking at what happened there. France is heavily invested in Greece. And on France, can I ask you about how politics may be getting in the way when it comes to this recent news about Peugeot Citroën? They had to slash 8,000 jobs, close assembly lines. But at the same time, they sanctioned Iran in terms of oil and in terms of car sales. Peugeot is in Iran, it's a big market for car sales. Is politics now getting also in the way? For example, in this case, as we see with France?
Well, I wish it was, but unfortunately, politics is scattered around. There is no convergence of politics in Europe. The political spectrum is still fractured between a group which is still leading certain countries and is the conservative group, which is linked to the recipe of austerity, and they will never deviate from that. Then there is a potentially new group of which Hollande in France is the beginning, that is more independent from that ideology of austerity and is trying to use the sovereignty as a solution and therefore public spending to alleviate the downturn and maintain some kind of dynamics in the economy. But the politics is really far behind, at least in Europe, far behind the interests of the banks that are manipulating the entire decision-making process, and we are not getting any better with the measures that they are undertaking. These measures, I agree, may risk to derail to severe unrest after the summer, when people come back, and will find extremely difficult to go through the next winter. So the situation is really pretty dangerous. I do not see the light at the end of the tunnel. There is need to address separate issues dividing the problems. So one thing is the debt of the states, one thing is the private debt of the banks, and then there are the industries. We have to separate these.
Okay, unfortunately, I got to jump in here. I do apologize. It's been a fascinating discussion. Thank you, Simon Dixon from banktothefuture.com, Max Keiser, journalist and broadcaster, and there from the Civi Foundation, Secretary General Paolo Raffone. Thank you for watching another edition of the Press TV News Analysis from Mikhail Vatahwe and the entire team. It's goodbye.